Welcome back, everybody. I am going to carry on my last segment of the cost segregation analysis, what it is, and why dentists should consider this when purchasing their building or doing a construction build out on a new space. We've covered a lot of ground in the last 3 episodes. This one will get a little more nuanced on a couple areas around depreciation, the types of depreciation, specifically the difference between bonus depreciation and Section 179 depreciation. We're going to talk very briefly about how states conform or don't conform to these rules. And we'll also talk about some of the red flags and green flags when you're looking for a cost segregation analysis firm to perform the research and to provide the report, which would become the basis for the tax approach to the depreciation and the tax savings. And also how cost segregation can play a key role in the negotiation and purchase process when buying the building. And then lastly, some really key tax planning comments that I want to share with you to make sure that all of this is being seen relative to an overall plan. Okay, let me first kick off by talking about bonus depreciation. In the last 3 episodes, I talked a lot about how when you buy that building and you commission this cost segregation study and you are able to break up the purchase price of the building across the different types of assets that the government, that the IRS will put the purchase price into. So let me put some real context here. You buy a building for $2 million. Now, in my last episode, I mentioned that you could usually front load or shift about 30 to 40% of the building into asset categories that allow a faster access to tax deductions. For example, the 2x4s on the building you bought are going to be deducted over 39 years. That's a long time to get the benefit. However, the cabinetry might be deducted over 5 or 7 years, and so you get that a lot sooner. So how much of your $2 million purchase price for the building should go toward the kind of shell and the walls, and how much should go toward some of the incidentals that are then attached to or added inside of that shell? What about the wirings going through for all of the IT? What about the HVAC? What about different aspects of the building that we could parse up and put into these different buckets such that you can maximize the tax benefit of those different buckets by depreciating them? Not all of the buckets allow you to front load the depreciation into the current year through what's called bonus depreciation or Section 179 depreciation. I'm going to cover both of those briefly here in a moment. But I do want to take a moment and pause on bonus depreciation. Bonus depreciation is the best of all depreciations because it allows you to actually have a loss, to go negative on your corporate net income, which then flows out to you on your personal tax return, which can be used to offset some other income. That could be very valuable. Section 179 doesn't. Now I'm going to elaborate on that a little bit more. However, bonus depreciation was scheduled to run out in 2026. 2025 was only going to be 20% of anything you purchased in the past could be bonus depreciated. However, Trump's one big beautiful bill, the OBBB, reinstated bonus depreciation on a go-forward basis. So if you do buy your building or construct a building going forward after 2025, you will still be able to now elect as much bonus depreciation you want for the portion of the purchase price of your building that gets allocated to the 5, 7, and 15-year asset categories. And that can be significant. Now, hold on to that thought. When I get to the end here and I talk about tax planning, you don't want to let the tax tail wag the dog just because it's a strategy you can elect to do. Doesn't mean you should, because it may actually harm you over a multi-year analysis. I'm going to talk about that, and it's incredibly important and something a lot of CPAs neglect because they don't do multi-year analysis often. They're simply looking at the current year and figuring out how to maximize your deduction today, when a good financial plan is going to forecast out and say, over the next 5, 10, 15 years, what is the most optimal tax strategy that net at the end of that time period you are best off.
Are you looking to buy or sell a dental practice? If you're a seller, how do you find a strong list of potential buyers? There's no MLS or Zillow for dental practice sales. In such a fragmented market, many dentists selling their practice feel discouraged. That's why I built PracticeOrbit.com. PracticeOrbit is modernizing how dental practices are bought and sold. It's a platform technology. Y'all know them: Zillow, Airbnb, Uber, and OpenTable, just to name a few. These technologies do two things. First, they help match buyers and sellers by centralizing the marketplace. Second, once the match between buyer and seller is made, these technologies help them navigate the sale to a successful close. Here are a few of the features inside of Practice Orbit. Users can determine a reasonable sale price for a practice in just minutes. All they need is the most recent business tax return. Practice owners can use the directory to find important service providers like practice brokers, attorneys, accountants, and bankers. Practice owners and their brokers can invite those service providers into the platform, so all parties are coordinating the sale together. Practice owners will have a beautiful digital listing of their practice, like a home on Redfin. And importantly, the listing will be anonymous, and personal information like your address, name, and pictures are only released after an NDA is signed and approved by you or your broker. Practice buyers can create saved searches to be auto-notified when new listings come on the platform that fit their desired specialty and location. And hey, dental practice brokers, you can list all your practices on the site for free. By doing so, you'll get access to Practice Orbit's large pool of buyers, all of whom have created profiles and saved searches to be auto-notified when new listings come for sale. You can use the platform to introduce your listings to a targeted set of buyers. Additionally, and optionally, you can use the platform tools such as a built-in NDA, a customizable LOI, and a workflow tool to navigate the sale from LOI to closing. In fact, you can manage all your listings on the system, from listing the practice to NDA to LOI and finally to closing the deal. Create your free account today at www.practiceorbit.com.
So with bonus depreciation, just know it is fully enforced that bonus depreciation can be elected at any time when purchasing fixed assets, or what are called capital assets. The purchase of a building is absolutely a capital asset. Okay, now let's talk a little bit more about the subject of Section 179 versus bonus depreciation. Again, I'm not trying to make a CPA out of you. However, as the CEO of your business, there are certain terms I do believe you should understand. Now, you probably heard about Section 179 because your dental supplier will come near the end of the year and tell you why you need to buy a new set of dental chairs, or buy that CAD cam, or buy that cone beam, or whatever that is. In order to get this 179 deduction, you need to buy it and have it placed into service by December 31st. And they will present it as a little bit of a magical tax deduction that's sort of pulled out of a black hat. The reality is all Section 179 is doing is it is accelerating when you get that deduction. So if you bought that dental chair, instead of deducting it over 5 years, as the IRS typically requires, if you elect into Section 179, you can deduct the full cost of that chair in the year that you bought it and placed it into service. That's what Section 179 is. Again, I got to emphasize, it's not giving you any new tax deductions. It's simply changing the timing of the tax deduction to receive it 100% in the year that you purchased that capital asset. Bonus depreciation is similar in that it allows you to accelerate depreciation also. But let me go through the differences between Section 179 depreciation and bonus depreciation. Section 179, as I said earlier, you have to elect it. If you don't elect it, then whatever you bought in that year, let's say it's a $100,000 CAD cam. You got the milling unit, you got the whole thing. And you want to deduct that in the current year. If you don't elect anything, by default, you will not get the Section 179 deduction. And so you want to make sure that you elect that. Now, when it comes to bonus depreciation, when you buy your building, there are some things that will automatically apply when bonus depreciation is allowed by law, and it has not always been allowed. It fluctuates up and down depending on the president in office. The more aggressive tax president is going to want bonus depreciation, and vice versa. And when it is allowable, it's automatic, and you actually have to opt out of bonus depreciation as opposed to opt into it. Let's go on to the second item here, the difference between Section 179 depreciation and bonus depreciation. Income limits. A Section 179 deduction cannot create a loss on your corporate income. So let's say you're December 15th and your net income is $75,000. You look at your profit and loss statement on the very bottom, it says $75,000. Now that's quite low. I would hope that you would have more profit than that, but let's just say it's $75,000 and you buy that CAD/CAM for $100,000 and you elect Section 179 deduction. Well, if you do that, it will bring your taxable income down to zero from your corporation, but it won't go negative. Section 179 cannot create a negative K1 for you. You can't deduct that loss. However, bonus depreciation allows losses. So there's no income limitation. You can create losses that carry forward or carry back. Speaking of carrybacks, that's the third item here. With Section 179, any 179 deduction that you were not able to use because it can't create a loss can carried forward to future years. And when it comes to bonus depreciation, losses that are created by bonus depreciation, you can use them to offset other income on your 1040 tax, certain other income on your 1040 tax return. But if you don't have other income to offset, you can actually carry that forward as well as what's called a net operating loss on your corporation. So if there's a loss created from either Section 179 or bonus depreciation, you're going to be able to use that loss. Even if you can't use that loss in the current year, it gets suspended, held in theoretical jar, and in the future, when you have income, net income, you'll be able to pull that suspended loss out and use it to offset income in future years. Let's talk about also phase outs. Neither of these really have asset phase outs that will apply for a dentist. For a larger business, there's a phase out of around, I think it's $3.5 million, and there's not many dentists buying equipment or doing a renovation that's going to cost more than $3.5 million. Now, for bonus, that's for Section 179 deduction. There is, at a very large amount, a very high level, a 179 deduction phase out if you bought that much. But like I said, what dentist is paying for things like dental chairs and x-ray machines and a few loops or whatever that's over $3.5 million? Not any. So that really is irrelevant for dentists. If you were a large manufacturing company and you had these huge manufacturing build-out costs, that could apply. Not the case here. With bonus depreciation, there is no asset purchase limit, but the bonus percent is phasing down. It was phasing down annually. It is now kicked back in. Okay, now when is 179 best used and when is bonus depreciation best used? If you have strong taxable income and want to reduce it to near zero, but not below zero, Section 179 is perfect. And Section 179 is something we use all the time at Practice CFO for our clients. The one thing I will tell doctors to be aware of, and you've heard me talk about this tax trap. If you finance equipment, let's say you finance that CAD/CAM and it's $100,000 and you have paid no money out of pocket because you financed it, and then you Section 179 deduct the full $100,000, your CPA is going to look like a hero in that year. You're not out of pocket at all, and yet you just got a $100,000 deduction. Probably going to save you somewhere around $30,000 to $45,000 in taxes. It's going to look fantastic. But then in the next years, when you're paying the loan on that equipment, you get virtually no tax deduction and your money is going out. And so it reverses and it catches up to you. And sometimes you have to buy more and deduct more Section 179 to recover from the prior year when you did that, and it can snowball out of control. So you got to be extremely careful. I typically say I match the cash flows from your bank account to the tax deduction. So if you finance it over 5 years, I'm typically going to depreciate it over 5 years. If you pay for it out of cash, I'm going to Section 179 deduct it to match the full deduction since you paid for it in cash. Now, when is bonus depreciation best to use? When you want to create the largest possible loss, especially with the LLC rental structure. And creating a loss, again, you can't do that with 179, but you can do that with bonus depreciation. And depending on where you are in the tax bracket and other assets or elements in your tax ecosystem, you may want to generate a loss out of your building in order to use that loss where possible. Now, I'm not going to go into all of the ways that you could use that loss. It is a bit restricted from other rental real estate properties because if you are the tenant and the owner, you are not able to use any net operating losses from the building LLC against income from other passive third-party tenant rentals that you own. All right, so the key insight here. With the LLC rental structure, bonus depreciation is almost always preferable because it can create a loss to shelter rental income with no income ceiling. All right, which states sort of conform, which don't? This is one of the chaotic things about the United States of America is you have federal tax laws and then you have tax laws at the state level. And although there is quite a bit of alignment, there is also a lot of misalignment. For example, the federal system, the IRS, has a lower tax rate on long-term capital gains. That's when you buy an asset, an investment asset, you hold it for more than a year, and then you sell it. So a simple example is you buy Apple stock, you hold it for a year, it goes up by 20%, you sell it, that gain is taxed at a lower rate, which for most dentists is 20% federal. However, most states don't have a difference, at least California doesn't, and a lot of them don't. They don't distinguish between a long-term capital gain and ordinary income. Ordinary income is the higher rate that you typically pay on your W-2 and K-1 income from work. So let's look at how the states may differ here from the federal rules around depreciation and cost segregation. Federal cost segregation benefits do not automatically apply at the state level. Many states have decoupled from federal bonus depreciation entirely. For example, California does not conform. California decoupled from federal bonus depreciation entirely. A $300,000 federal deduction may produce zero California deduction. So dentists in California should still do cost seg for federal benefit, but must plan for the state tax shortfall. This is why good tax planning needs to look at both federal and state tax planning, especially if you're in the high income tax states like California and New York. New Jersey does not conform with federal rules either, often using pre-Tax Cuts and Job Act, that's the 2017 Trump tax bill. Bonus depreciation claimed federally is added back on the New Jersey return. Texas and Florida, they have no state income tax, so it don't matter. Same with Alaska. Those ones are easy. New York partially conforms. The state deduction is often less than the federal deduction for bonus depreciation. And Illinois, same thing. And all other states, you just got to verify that with your CPA, or you can search that up in your AI model as well. But sometimes these AI models hallucinate and they get it wrong. I find that quite a bit. They use old data, for example. So be sure to consult with your CPA on this at the state level. The bottom line, always model both federal and state tax impact before projecting total savings from a cost segregation study. Okay, now when you're going to find that company that's going to help do the analysis, and you're going to pay them some money, you want to make sure that they are qualified. This is absolutely critical. In every field, there are people who are very effective at what they do. They have mastered their domain. And there are people who have not mastered their domain. They haven't done the proper studies, the proper credentials, the proper education, and they may be able to put forth a good sales pitch, but they may not be great at what they do. This happened a lot with the employee retention credit, the ERC. There are a lot of shark companies out there saying, hey, I'll do your ERC and you'll pay me 25 to 30% of whatever your credit is. It was complete predatory practice. A lot of doctors fell for it. They ended up paying $40, $50, $70, $80, $100,000 to these companies who then walk away. They hold no liability. And now you're left holding the bag in case the IRS does come and audit you and makes you pay it all back. You're not going to get that money back from those sharks out there. There's a lot of these people. So many people in this world want to get rich fast. And so wherever there's an opportunity that comes up, a new tax law, whatever, and they capitalize on it by presenting something that sounds shiny and wonderful, only to really line their pockets at the doctor's expense. I shared a few episodes back. I think private equity is doing that a lot in the dental space with these incredible smoke and mirror, but what look like promising offer letters. When you really run the numbers, really look at them, you realize these things are really accreting money away from the dentist into the pocket of a bunch of fancy, intelligent business people. So be very careful here. The same thing when it comes to a cost segregation analysis. So here are some of the green flags in companies that you might be looking at. You want to make sure they have a licensed engineer on staff who does conduct a physical site inspection. Red flag is when there's no engineers and the study is done entirely by a CPA. A CPA isn't looking at design and engineering documents of a building in order to properly do that. And if the IRS were to audit you, they're going to want to see that that was done. All right, another green flag of a good company doing a cost segregation analysis is they reference the IRS cost segregation audit technique guide compliance. And red flags is when they do a desktop or a modeled study, no physical inspection of the property, and they don't really reference and use the IRS cost segregation audit technique guide. All right, another few. I'm just going to go through the green flags directly, and then I'll do the red flags. So a good company is going to deliver a written asset-by-asset report, not a summary spreadsheet, but a much more detailed asset-by-asset. They're going to outline it. They're going to inventory everything so that we know what's going in each of the asset buckets. All right, a good company is going to have explicit written audit support policy. They will defend the study if questioned. That's absolutely critical.
Do you ever feel lost in your practice finances? And how about your personal finances? Ever wonder where your hard-earned money goes and why you're not seeing the financial progress you worked so hard for? If so, listen up. As a dental CPA and financial planner, I've created our company, Practice CFO, just for you. With almost 2 decades of experience, Practice CFO integrates great CPA services like accounting and tax with customized financial planning, both business and personal. Think of it this way. Our dental-focused CPA services give us the X-rays we need to clinically plan your global finances and be effective financial planners. It's a highly customized approach we call the CFO model. Historically, having a CFO or chief financial officer was an advantage of large corporations only. But today, Practice CFO gives that same advantage to private dental practice owners. As a client of Practice CFO, you'll be assigned one of our dedicated CFO advisors. You'll receive insightful financial reports each month, have regular financial review meetings, reduce taxes, grow your wealth, and feel more in charge of your numbers. Because we believe that in the competitive landscape of dental practice ownership today, you have to be an effective business owner, not just a capable clinician. Reach out to learn more at www.practicecfo.com.
They typically will have a flat fee structure, not contingency-based. Again, that is so important. Stay away from contingency-based vendors, typically speaking. Because what it does is it incentivizes them to put you at risk with the IRS. And I mean, one could argue that the good thing about that is they're going to try to maximize the tax deduction. I get that. But what I believe and have seen is that companies that are paid as a percent of the tax savings tend to bear more risk than they should in their recommendations because they know that you are the one who's carrying the risk and they simply get their share of the reward. So be careful there. You want a flat fee structure. Lastly, a good company will have performed studies specifically on dental office properties. So they have background in dental offices because there are a lot of unique aspects to a dental build-out. There are. All right, a few more red flags. Red flags, contingency pricing. I talked about that. Refusing to provide written audit support or defends only up to 50% or defends only to 50% confidence. So they're not standing by the defendability of their study. They promise an unusually high reclassification percentage without even seeing the property. So if they're like, yeah, hey doc, I think that we could reclassify 60% of the purchase price into these other asset categories to then accelerate those depreciation on those categories. Because remember, you cannot depreciate or bonus depreciate the 39-year category, which by default is what the non-land portion of the building will go to. So the whole cost seg is to say what portion of the non-land amount of the purchase price for the building can we put in these other categories in order to then depreciate those faster. So if they're promising you things that sound too good to be true before they've even inspected the property, you should probably turn and run on that. Lastly, your general CPA is doing the study without a specialist on the team. Yep, again, there you want to avoid that. So the IRS, bottom line, has specific audit guidelines for cost segregation, and a quality firm will proactively reference them. A low-quality study invites far more scrutiny than no study at all. Okay, and lastly here, when you go to buy the building, before I get to our tax planning comments here in a moment, when you go to buy the building, it is best practice, in my opinion, to do a preliminary cost segregation analysis before you actually sign the dotted line. So while you're in due diligence, you may have an offer in on the building, and now the attorneys are doing their thing, negotiating the purchase contract, and you're getting lending. So there's underwriting taking place. All that's happening, and it's usually a 6 to 12 week period for all of that to finalize. Here are some things that you can be doing during that period to understand what the tax implications are of buying this building if you do a cost segregation analysis. So when buying a building from the market or from your landlord, a cost seg analysis should be part of your pre-closure due diligence, not an afterthought. So step one, purchase price allocation in the contract. How the purchase price is split between land, building, and personal property in the purchase agreement directly affects your depreciation. And I've said this in the prior episode that land is never depreciable. However, therefore, a higher allocation to personal property means more accelerated depreciation. And that is the name of the game. How can we move more away from land, more away from the 39 asset class, and more into the 5, 7, and 15-year asset class, which is that 5, 7 year, you're really looking at personal property in there. And when I say personal property, don't think of like your car or your home, not that type of personal property. It's property that you could sort of unplug, pick up, move out, walk out of the building with. That's what I mean by personal property. Business personal property, which sounds like an oxymoron, but it's not. A higher allocation of that personal property is what you want to get. This should be negotiated before you sign to buy that building, not discovered after closing. So in the same way, when you bought your dental practice, you have to say how much of the purchase price is going to goodwill and how much is going to dental equipment and how much is going to furniture and fixtures and how much is going to a non-compete agreement and how much, if any, is going to purchase the accounts receivable. You have to take the purchase price and spread it across those different assets. Well, same thing with the building. How much of this is the 39-year property? How much of this is a personal property that we can put in the 5, 7, or 15-year category? And you want to put that in the agreement when you're buying the building. That way, the buyer and the seller are aligned in what they report to the IRS for tax purposes. Okay, number two, this analysis could inform the price. So a cost seg analysis before closing tells you the true after-tax cost of the building. Two buildings with the same sticker price can have very different net costs depending on how their components are composed. A dental-rich build-out, lots of infrastructure already in place, is worth more on an after-tax basis because you get such a good tax deduction for those items. And then lastly, the land value must be isolated and verified. Land is excluded from all depreciation. If the seller or appraiser allocates too much to land, especially in high-cost markets like Southern California, your depreciable base shrinks. A cost seg firm can help establish a defendable land improvement. So you want as little allocated of the land as possible. It's a common mistake to not do that. So the rule of thumb here is if you can get a preliminary cost seg analysis done before closing, do it. The information is worth more than the study costs. All right, let's go ahead and finish up here with the concept of tax planning. You will hear me say this a lot, that I don't believe the tax tail should ever wag the dog. And it's very common for dentists to latch on to a single strategy and then suddenly, in doing so, turn a blind eye to the cascading implication of other areas in their tax planning that are affected by that initial strategy. So all strategies play into each other. There's a relationship between making one decision that will affect your bottom line net profit and other decisions that also are attempting to affect your bottom line net profit. And I'll give you a couple of examples here, but I want to start high level and say you have tax brackets that you are exposed to. And let me just get back. Okay, here we go. Let me just tell you what those 2026 federal tax brackets are. And I'll say married filing joint here, if you don't mind. The individual tax rates for non-married people will be half or substantially less than this. But let me go to I'm just pulling one up right now on Google. So married filing joint, up to 24, from zero taxable income. Again, this isn't collections. This isn't operating income. This isn't even your bottom line on your profit and loss statement. This is on your personal 1040, which is going to be the sum of your W-2 and any K-1s you have, and a spouse income. But this is on your 1040. Any net taxable income between 0 and 24,800 is only taxed at 10%. Then from 24,801 to about 100,000, I'm going to round here to keep it simple, that roughly $75,000 leg of your income journey is taxed at 12%. Then from 100,000 to 211,000, it's taxed at 22%. Then from 211 to 403, it's taxed at 24%. Then from 403 to 512,000, it's taxed at 32%. Then from 512 to 768, it's taxed at 35%. And then anything above 768 is taxed at 37%. Now, a couple key concepts here. Number one, it's not retroactive. So if you get to that top bracket and you're making, let's say, $800,000, you're in the top 37% federal bracket, not all of that is taxed at 37%. Only the amount above $768,701 is taxed at that 37%. So that's why they call this a progressive tax scale. They're like stairs. And every stair starting at the bottom is taxed at a given rate. And only when you get to that next rate is that new stair taxed at that new rate. And so still your first $24,800 is taxed at 10%, and the next roughly $75,000 is taxed at 12%. That doesn't change. That does not change. The second thing I want to mention is that this is federal only. So depending on your state, you got to add to your state. So federally, if you're in the 37% tax bracket because you're cranking it and you're in California, you're going to add another 10 to 12%. You're approaching 50% income taxes there in certain states when you combine the two. So these stairs, these tiers within the tax bracket are really important. If you can keep 100% of your income inside of the 24% tax bracket or less, you're eliminating a lot of the tax headwinds. Once you start to get up above 24, now you go from 24 to 32. That's an 8% jump. Notice the jumps from 10 to 12, that's 2%. From 12 to 22%, so that's 10%. And that's all the way up to 211,000 married filing joint. If you're single, that's 105,000. But then it's only 2% from 22% to 24% to go from 211,000 to 403,000. So that's a low amount. But then there's this big kick up from 24 to 32% in between 403,000 and 512,000. That's all taxed now at 8% higher in that extra roughly $110,000. And so it's when you start to get up your taxable income closer to 500,000 plus, now you're really dealing with some tax headwinds. So what I don't want, here's the thing, I don't want you to cost seg, bonus depreciate, have huge losses, and then for like 3 or 4 or 5 years, your income is in the 12 to 22% bracket because you created so much loss that you essentially brought your income very, very low in those first few years because you bonus depreciated the cost segregation study results. I mean, you're going to feel great. It's going to feel really good. But guess what? All we're doing, remember, is we're front loading 39 years of depreciation on the building into the first handful of years, and it's going to feel great. But then after that, you're actually going to get significantly less depreciation than had you never done the cost seg and bonus depreciation in the first place, because it would have been straight line from year 1 to year 39. But now you've pushed a bunch of that up in the first few years. So what happens? Suddenly you see this steep rise in your tax brackets after those first few years. Significant rise, even though your cash flow is going to feel the same. You're still collecting the same amount. Your overhead is about the same. Your debt is about the same. Suddenly, your taxes skyrocket. And you're just like telling your CPA, what the heck is going on? Last year, I only owed $6,000. Now you're telling me I owe $90,000? How can that be? Well, it's because there wasn't proper planning and at least proper expectation setting by the CPA when this was done. And here's the other thing. There are deductions you get, and if you're on YouTube, you can see my screen. There are deductions you can get if you keep your income below roughly $550,000 or so that phase out once you get above that amount. 2 key ones are the qualified business income deduction, the QBI deduction, which is a wonderful thing for small business owners. And the second one is child's tax credit. If you have kids and you're married, once you hit around $550,000, you start to lose the benefit of the child tax credit. And also some Schedule A itemized deductions start to get lost as well. So there's a handful of deductions that once you get up to about $550,000 to $600,000 married filing joint, half of that for single, you start to lose those other deductions that you would have got beforehand. So if you front load all your depreciation and you just like go the full 9 yards and you're in the 22% tax bracket for 3 or 4 years, and then suddenly over the next couple of years it just skyrockets, well, you're going to lose out when it skyrockets on these other deductions like the QBI, the child tax credits, certain qualified income or itemized deduction totals that can start to get phased out. You lose those things. So in some ways, I don't necessarily want to see you getting down in the low 22% bracket only in a few years to then have going forward being in the top tax bracket where you lose all those other deductions. I would rather pace this out and do a forecast and say, what is the optimal rate at which I should be accelerating deduction from a cost segregation study and the related accelerated depreciation and the bonus depreciation? What is the right configuration over the lifetime of deducting the cost of this building, and such that if I present value it in today to help me understand what the true value is, which one will create the most tax saving and allow me to keep the most money in my pocket? So that is so key. And so many CPAs just rush to take every deduction you can today, even though you're actually going to leave a lot of good tax deductions on the table in the future because of that decision. It was short-sighted, marginal thinking, and a lot of times historians, which CPAs are, tend to think on the margins, not think in big picture. All right, last thing I'm going to say is around tenant improvement allowances. As you know, if you do a if you're the landlord and you pay for tenant improvements to a third party who's renting your space, question is who gets the tax benefit of that tenant improvement? Or maybe you don't own your building and you're doing a build out and you're asking the landlord to pay for some of that build out because some of the benefit runs to the landlord. It's their space and you won't always be there. And so they are getting a benefit. And so it makes sense sometimes for the landlord to pitch in what's called a tenant improvement allowance. So who owns the depreciation when the tenant is doing a build out? They pay for a lot of it and the landlord pays for some of it. Well, here we go. If you fund the build out yourself versus receiving a TI allowance from the landlord, you own these improvements and you can depreciate them. If a landlord funds the build out via a TI allowance, the landlord depreciates it, not you. This distinction matters enormously for dentists who are buying a building to operate in. The entire clinical build-out should be owner-funded and documented for maximum depreciation benefits. So structure your finances accordingly. So bottom line, whoever comes out of pocket and pays the cash is the one who gets the deduction. So what I'd probably do if you're doing a build-out, and let's say you don't own the building, and you are negotiating a tenant improvement allowance from the building owner, I would try to have the landlord pay for the portion of the build out that would go to the 39-year asset class because that asset class cannot be bonus depreciated and get that benefit. You come out of pocket for the 5, 7, and 15-year asset classes, which would make a lot more sense because a lot of the things that you're putting in, like maybe some structural issues for dental chairs, maybe you're adding a space to get it plumbed for a new operatory, but those things can be accelerated faster through the 5, 7, and 15-year property asset classes. So be smart about that. Consult your CPA, and these decisions matter a lot. I will end with this final statement. Dentists are incredibly intelligent people who make very good money. However, like a lot of individuals, most of individuals, to be honest, including even accountants, oftentimes they believe that they can structure these decisions strategically on their own and optimize those decisions. Why? Because they are intelligent. They have a PhD and they know how to study. They know how to research extremely well. But these are complicated matters. And patching them together in a holistic view to optimize the entire ecosystem can get quite complicated. Layer on top of that some of the psychological and emotional aspects of money, and it even gets a little bit more tricky as well. So try to understand that it's not about the cost when you do a study or engage an advisor to help you make good financial decisions. It's about the outcome. And I've said this before, I'll say it again. The most important thing you could do when finding good advisors to give you good advice is to do multiple interviews, whether that's a dental CPA and financial advisor like us, or it's a cost seg analysis, or whether it's an attorney or a practice management consultant or a marketing company. Do various interviews. Ask for data. Maybe ask for some references. Do some study on it, because who you choose on the roster has a significant effect on the outcome. But I truly believe you get the right people in place as your board of advisors who are competent, who are plugged in, who are responsive, and who communicate well together. You can create a significant return on investment by getting the right type of advice. When you get into these higher tax brackets, when you have higher cash flows, you have more complexity, small errors can be extremely costly. I've even seen simple QuickBooks accounting errors cost hundreds of thousands of dollars to dentists because they wanted to pay a dirt cheap bookkeeper down the street who didn't really understand dental and didn't do proper accounting on a lot of the transactions. We get them years later and they overpaid in taxes significantly because of simple bookkeeping mistakes, let alone tax planning mistakes and missing tax planning opportunities. So it's just so incredible that you understand that at your level as a business owner with an increase in income and an increasing tax bracket, good planning goes a long way to help you feel financially organized and accelerate financial independence. Thanks, everybody, for listening to the series on cost segregation. Hope it was helpful. Stay tuned. I've got some great content and episodes coming up. Excited to share with you. I want to dive more into the personal financial planning side. That's really at the end of the day where my heart is. All this stuff about tax and accounting and strategies ultimately is to drive what is the thing that I value and care for the most here at Practice CFO, which is your personal financial security, growth, and independence. And so stay tuned for some really exciting episodes on that. I'm really looking forward to it. Until then.